Hello and welcome back to the TradeNeon YouTube channel. And also welcome back to our market analysis video series where we have a look at a market that is currently fundamentally interesting and analyze it within Futures Insights, discuss it a little bit and talk about what's important for this market. If you don't know me yet, my name is Simo Reichert. I'm part of the TradeNeon team. And in this video, we will have a look at the Lean Hogs market with the symbol LE that is traded at the CME. That market is definitely fundamentally interesting right now, but I think that much can be said in advance. There will be a plot twist at the end, so definitely stay tuned for that. And as always, before we head into Futures Insights, please be aware that trading in derivatives or securities in general involves significant risk, and please don't take this video as investment advice or intermediation. Okay, now we are in the Futures Insights dashboard, and as always, we are going to start off with the dry powder indicators for the managed money side, so the speculators, the large speculative institutions. And right off the bat, we already got quite the convenient situation because we have two extreme positions. On the one hand, we got an extremely high open interest for the long side and a relatively low, quite a minimal amount of open interest for the short side. This is already quite interesting for us because this kind of extreme open interest placement for the managed money side holds the potential for long-term price reversals. Now, why even is that the case? In this specific scenario, we can see that the managed money long side is positioned, well, far above their usual standards. You can see this is the chart where they are usually positioned. As you can see, some dots are already kind of faded. This simply means that are further into the past, and the points that are even brighter are closer to our current date. And when you take these dots into account that are close to our current date, we simply don't have to focus on these dots that are so far into the past because they are simply not relevant to us anymore. But if you take these dots into account that are quite relevant for us, then you can see that the managed money side is approaching an extreme state at the moment. And this simply leads us to the question that if all of the trading institutions are already long engaged, who is going to build up even more long open interest? Obviously, it could always happen, as we can see right here in 2024, that we had an open interest that was even higher. So this simply means that we had more trading institutions involved with a higher open interest, but that's why we got this historical comparison that you can see where the open interest is usually positioned. Now, on the other side, for the short managed money side, this is not quite as interesting for us. This is still relevant for potential short trade, but it's not as relevant as the long side because we can simply get the information from this that if a short trend was to develop, that we could definitely expect a lot of support from the managed money side still for potential short trade because, well, at the moment they simply have no open interest in the market whatsoever, so they can still build up a significant amount of positions in the market for a short trade. So what we can get so far from these indicators is that the managed money side definitely gives us a short bias for the meat market. And now in a second step, we can further validate this impression by having a look at the OBOS indicator, which also relates this current position to a specific set of variables, which include the price, in this case, from the look back period. So in this case, it would be the price from the last year. It also relates it to the amount of trading institutions involved and also to the total open interest. And when you do that, or when the indicator does that, we get this fancy looking graph over here that gives us these signals for the meat market, which tend to be quite accurate in this case. So as you can see, it comes with quite impressive accuracy, I would say. But one thing you certainly don't want to do, and one thing that we always stress, is to not mistake these signals for actual trading entry signals. The reason you don't want to do that is simply because these signals or the fundamental data in general gives us an orientation in which direction we want to think from the midterm to the long term. If you were to move these signals directly, then it could definitely happen that the market is moving sometime against you, which is obviously quite inconvenient, and that the market simply has not given us, in terms of the chart, any confirmation that the price is now going to reverse, for example, in this case. But with this out of the way, let's have a look if the OBS chart for the managed money set is even giving us a short signal. Already looks like it. Yes, we get a 90% signal, which simply means that this is the 90th most extreme signal that we got from the last year. And the signal that we get basically also completes and further validates our short bias that we have for the Lean Hogs market, because the OBS indicator basically now tells us that the current COT position from the managed money side is interesting for the short perspective. Now let's move on to our PMPU side. First of all, our dry powders indicators for the PMPU side. And this is already quite an interesting and also uncommon situation that we have in the market right now. What you can see here is that the PMPU side, which is basically our commercial traders, so PMPU stands for producers, merchants, processors, and users, are buying extremely much, and they're also selling extremely much. This is a bit contradicting, because usually they would either buy very much and sell very little, because that would simply mean that they deem the current prices as quite low, or they would sell a lot and only buy very little, which simply would mean that the prices are currently very expensive for them. Still, the OBS indicator tells us that we got a short signal right now with 84%. So this simply means that if we relate the current position to all those things, the current price, then the amount of involved market participants and the total open interest, that the current position is more interesting for the short side. Now let's quickly address the open interest. So what you can see right here is the price in green and the open interest by this blue graph right here. What you can see is that these two things are usually positively correlated. What is interesting is that the open interest and the price were recently diverging, starting from this peak right here in early December, and it dropped all the way to this point right here in April. But this move or this development was recently corrected by this short and abrupt surge when it comes to the open interest. So this is now corrected, and this also means that the market is now quite liquid. So this is obviously very convenient for us for minimal spreads, and also for secure entries and exits, for example, when it comes to the options market. The flow cube is also quite interesting at the moment, because it simply shows us that this downwards move right here is not because new short open positions are formed, but rather is because the long positions that we had in the market are now liquidated. What we can see right here, so we had strong long liquidation, weak long liquidation, and strong long liquidation, which simply means that the price is falling, and also the open interest is also falling. And obviously it would be even more beneficial for a potential short trade if we were to see that now finally new short positions are formed in the market. What is also a bit inconvenient is that the recent short season that started early May and went all the way to the end of June just finished. It would obviously be even more beneficial for a potential upcoming short trade if we were now to enter a short season. A short season would simply mean that the market in this time frame, in the last at least 9 out of 10 years went short. Obviously, this time it didn't work out whatsoever, but usually these are quite practical because obviously we have the statistical advantage on our side with these seasons. But now with this out of the way, let's finally address the plot twist I promised you earlier, which is the term structure. Now, so far, all of the fundamental data was either neutral or told us that the short perspective is more beneficial right now and that we should look for short trades. But the term structure is definitely putting a stop to the short bias because at the moment we got a backwardation in the term structure. A backwardation usually stems from supply shortages in the market, which basically leads to a term structure that is not in the normal stage, which would be that the future contracts that are further out in the future become more expensive in comparison to the future contracts that are closer to expiry. And this is also how it should be because, well, with the future contracts that are further out into the future, the underlying good has to, that is at least one reason for it, has to be stored for longer, which obviously results in additional costs. But with a backwardation and in terms of supply shortages, the market participants want to attain this underlying good as soon as possible because they are simply unsure whether they will get this underlying good in the future, which basically shifts the price dynamics and makes the future contracts that are closer to expiry more expensive than the future contracts to follow. And during those times, we certainly don't want to do any short trades because this is massively favoring higher prices. And if the supply shortage was to get even worse, which we can see in this term structure difference indicator, is that the price is quite sensitive to that. We can see that right here by this red line right here. What we can see here is that the supply shortage was increasing at an extremely high rate, and that the price was definitely following, which we can see by this spike right here. And we recently had that again in March, where supply was decreasing, and you can see that the price followed. What you can see is also that the backwardation at the moment is decreasing. So last couple of days, we definitely got these short signals right here, but we should not overinterpret these. And I would also say keep our fingers still until the term structure has normalized, which would simply mean that this line right here is below zero, because this would indicate that the font contract is again cheaper than the future contracts to follow. So concluding from what we have seen, this is obviously a bit inconvenient for us because the other fundamental data besides the term structure is definitely pointing out that we should look towards trading short, but obviously with the term structure, we don't want to do that. This is also the reason why we don't want to look at any fundamental indicators in isolation, but we want to keep a holistic view of the whole picture. And otherwise, without the term structure, we would think that right now is a perfect situation for a short trade. But now with the term structure, again, as I mentioned, we don't want to do this. And this also brings us to the end of our analysis. If you have any questions or recommendations, whatever, please feel free to send us a message and we will get back to you as soon as possible. With that being said, I thank you very much for listening, and I hope to see you again next time.